right, what is up, and welcome back, everyone, to another episode of the Long Game Podcast. I'm your host, Thomas Kopelman, and here with me, we got Wes and Doug from Alpha Architect. I feel like we're kind of sitting in front of some very, very knowledgeable, very well-known people, and we're going to talk about, really ESOPs in general, but mostly about, hey, here's some opportunities, some different ways that you can sell your business. I think we have to start there, but then most of the conversation is going to be structured around ESOPs. So maybe before we dive into it, quick little overview from you guys, who you are, and kind of, I think that'll naturally show why you're the right people to talk about this with.
Sure, I'll kick it off because I think in the end, Doug's the expert on the very niche topic we're going to talk about here. But high level, I kind of run Alpha Architect. Between Alpha Architect and our ETF biz, we probably have $22 billion. Been in business for over 15 years now, and we are very, very hyper-focused on finding ways to leverage the tax code to maximize tax efficiency and investment outcomes at affordable cost for clients. And one of those business lines is the 1042 QRP rollover opportunity, which Doug and his team, they run that entire business and know everything about it. And so he can give his intro on how he got into this and his background, which is very interesting.
Yeah, I joined the firm in about 2016 to build this business. It's a 1042 qualified replacement property business, which is integral for business owners who are selling their businesses to their employees, as I think this ESOP topic is germane. And we've built that business now today with over 100 investor households who've transacted in the M&A market space to sell their businesses to their employees. It's a wonderful, wonderful business from the perspective of helping better communities, better employee outcomes, and better business owner outcomes as well.
Okay, cool. Well, let's kind of segue into the conversation for today. So before we decide and talk about ESOPs, when a business owner has the ability to sell, what are the main tools that you see them evaluating? And I think then only from there we can talk about why you guys really like and think ESOPs are one of the best tools.
I'll dive in there. So I have an M&A background from a prior career, and what we typically saw was either selling to a peer, a competitor in the industry, whether through a merger or through a cash sale, or selling to private equity. Typically, private equity brings in leverage and buys out the company. Other alternatives include selling to the company itself through something like a management buyout or a corporate buyout of the owner's stock. But those are the conventional ways, with a mantra typically of maximizing shareholder value. And when we discovered ESOPs, we realized that they're kind of a less efficient version of a tax efficient transaction. That's why ESOPs have been such a delight to build.
Okay. So yeah, basically if I'm selling my business, you either have like maybe a partner could buy you out, maybe you have private equity, maybe you just kind of go and say, here's some competitors. I want you to buy me out. When that happens, you either get full cash up front, you might have some cash plus earn out, you might have cash earn out, roll up into the new entity. But those are really the main ways that you're going to sell there. And then now there's this whole side of like, what if we want to sell internally to our own company? And so let's have you guys just kind of give us a quick overview of really what an ESOP is and fundamentally how it works.
Well, before we even start there, I think it's really important to understand the incentives of the marketplace. It's because it'll allow us to understand why a lot of business owners do not hear about this, even though Doug will explain why it's so awesome, because this is important. So the reason a business owner does not hear about this is because there's not good incentives, right? Who gets paid when you sell your business? The investment bankers. Who gets paid when they buy your business and leverage it up and fire all your employees and send them to the curb? Private equity. Nobody gets paid by recommending an ESOP. So the only way a business owner will hear about this venue is through a fiduciary type advisor, where they're just trying to do what's in the best interest of the client. So just to be clear, the reason this is such an esoteric space where most people are like, what the hell is this, is because the salespeople out there in the marketplace do have zero incentives to tell you about this. So I'll shut up now, and Doug can explain why it's so awesome, but I just want to make it clear that it's not some weird issue. It's an incentive alignment issue, which is why you only would hear it through RIAs and independent advisors.
I think that's a really good point though, right? Because like obviously the transaction fees or the buying fees are pretty high in this. And so you make a lot of money being able to do it. So why are they going to push you into a lane where there's no commission? And people hate on the advisor 1% fee. The fees are a lot higher on selling your business than 1% too.
Yeah, especially at this size. I mean, we're talking about companies that are generally in the $10 million enterprise value to say at the sweet spot, $10 to $60 million. Although we've got investors who sold companies much, much larger than that, up to $1 billion in enterprise value.
Wow.
And at that middle market level, 10 to 60 million, say, those fees can be pretty extensive. 6 or 7% is not unusual to see in a brokered transaction like that.
That's a lot.
Yeah, but in an ESOP transaction, the sale prices and the sale fees, I should say, are much, much lower. An M&A advisor will get fired for trying to bring an ESOP to the table for his commitment committee to get behind. So that's why this is such a small industry, and it's kind of opaque from the outside. You don't hear too much about it, again, as you just said, Wes, because no one gets paid properly for it, except those specialists who are in this business. It's a national industry, meaning an advisor who forms ESOPs on the West Coast might be advising clients all over the country, and that's typical of the space. So it's a small industry, it's a national industry, and you can't really get rich being an advisor to the ESOP space if you're just focused in your local market. You have to be able to service clients across the country.
Yeah, that makes sense. Okay, so let's go into like what is an ESOP? How does it work?
An employee stock ownership plan is formed for the purposes of acquiring a company. So what happens? A business owner explores his or her options to sell the business. And as I said, you could sell to third parties, which involves kind of an invasive due diligence process where you can decide to sell to your employees. And that process really involves setting up a trust that is to hold the securities that the business owner owns currently. And that trust becomes a qualified retirement plan for the employees. I know it sounds complicated, but effectively the business owner is just determining that he's going to set up a trust, kind of like a 401k plan, that will hold the stock that he sells to the trust. And essentially that trust then becomes the owner for the benefit of those employees. And so it is essentially a qualified plan. And the final end stage of this structure is that the owner of the business is a tax-free entity, right? A qualified retirement plan doesn't pay capital, it doesn't pay taxes rather on the business's income. And so the end state is to have a tax-free entity owning the cash flows of the businesses, not paying taxes at the federal level. Don't worry, the government gets their money other ways. And the business owner is bought out. And the incentive to go through that complexity is that the business owner and the company itself enjoy a range of tax benefits, not the least of which can be that the business owner can defer or eliminate the capital gains taxes on his or her sale of the stock to the employees.
Okay. So let's break it down and let's just do like fundamentally. So, hey, I am a business owner. I got X number of employees. My goal is, we found the value we're going to sell for $30 million. So trust gets set up. My shares go into that trust.
Yeah, I think the best way to think of it is you're going to hire, as a business owner, you're going to hire a trustee as part of the transaction who will be in charge of acting as a fiduciary on behalf of the employees and negotiating that sale transaction of your stock to the trust. So you're essentially hiring your counterparty. That transaction by law has to occur at fair market value so that that's a definition of value that essentially equates to the type of values paid by, say, private equity firms. In other words, synergies don't really come into play in terms of determining the value that the employees are allowed to pay through the trustee for those shares. But you're hiring a counterparty, you're negotiating the transaction, and at the appropriate time, a closing, which looks like any other closing, has typically financing and ESOP attorneys and corporate attorney at the table transferring shares in escrow to the ESOP trust. Now, the employees don't enjoy those shares, the benefits of those shares, until the ESOP itself starts actually paying the owner for the shares. That's introducing a bit of complexity here, but a business owner will typically not be able to buy himself out entirely for cash at closing. He'll have to take a seller note or some proportion of his proceeds in non-cash. And then as that seller note's paid, those shares get allocated to the employees on that basis.
And how long does that typically take then for this owner to start to see the money from the sale?
The business owner will typically get 25 to 35% of the transaction value proceeds in cash. So he or she will walk away with some chunk of cash at closing and then a seller note, often for the rest, as well as maybe warrants. And over the next 5 to 6 to 7 years, in our experience, the company pays through the employee stock ownership plan the proceeds of that company's business revenues to the business owner to essentially amortize or pay down that seller note.
Okay.
So some shares are allocated initially in the amount of that cash, but other shares typically will only be allocated as the business owner is receiving payment on the seller note.
And so that cash injection that they get up front, where exactly does that come from? Is that coming from like a loan?
And I think that's the most important question. Often a company will not really have the ability to borrow 100% of the proceeds to buy out the owner. And so what will happen is that a business will, leveraging its existing banking relationships, get a secured bank loan, secured typically by the working capital of the business, to form some component of cash proceeds at closing, as I say, typically around a third or so. And that loan is a senior loan offered by the bank to the company, and the company has to service that loan. So that loan is senior to the seller note or the promissory note that the company has given the business owner for the rest of his proceeds. And so as the company starts to pay down that senior loan to the bank, as a profit maximizing entity, will often say, hey, it's time for us to refinance that seller note now. And they'll often approach the company to refinance a piece or all of that seller note in time. That happens usually, as I say, about over a 5 or 6 year period, typically through 1 or 2 or 3 refinancing events every 2 or so years.
Okay, so I'm the owner. I get some up front, and then I get paid, yearly based on my employees starting to buy in. So then you talked about the advantages of not having to pay the capital gains tax. So then how really is this tax to the owner?
Yeah, so let's break it into 2 types of benefits. There are benefits to the company, in the sense that when a business acquires stock from the employer, from the owner, for the employees through an ESOP, the transaction is essentially a tax. So the purchase price of the company is tax deductible. And why is that? Well, because as the company is funding the ESOP, right, just as it would fund, say, the employer portion of a 401k, so as the company is funding the ESOP over time, those payments are essentially cycled through the ESOP, which has a intercompany loan note to the company, and so it's paid back to the company to pay down that intercompany loan. The company then is able to use that as a debt repayment to the bank and so forth. And so all of that becomes tax deductible. Those payments to the ESOP are tax deductible. And so those payments by definition will equal the value that the ESOP is paying to buy the company. And so over time, the purchase price of that acquisition becomes tax deductible to the company, making it a really efficient way to buy a business. On the employer side, on the business owner side, when I sell my stock to my employees as a business owner, provided I've met a few requirements. So for example, for a tax-deferred sale through a 1042 sale election, the business owner has to effectively either sell 30% or more of his or her stock, or be part of a group that is selling 30% or more by the close of the transaction. So 30% has to be in the hands of the ESOP to have the critical mass to be a tax-deferred 1042 sale. And then the business owner has to have held that stock for at least 3 years. So that's effectively what qualifies the stock. He or she cannot participate as a planned participant in the ESOP afterward.
And buy more shares back that way.
Anyone who's got 25% or more of the stock is effectively barred from being a participant, or even family members of the owner. But putting that aside, the business owner is going to receive the opportunity to roll over those proceeds into something called qualified replacement property. Sorry for the terminology, there's a lot of jargon. The qualified replacement property is effectively the amount of proceeds that are received by the business owner from the sale. As long as he rolls that into a qualified property, then there's no capital gains tax paid on that sale transaction. And as long as the business owner owns those properties, taxes are deferred. And if the business owner dies with that property in his or her estate, then the taxes are eliminated.
So what would be considered the qualified property?
Yeah, there are a handful of things that would qualify, but by and large, it's the stock or bonds issued by domestic operating companies. And so that's a kind of a vague definition that includes U.S.-based corporations that have passed a passive income and a passive asset test. So they have to have a percentage of their income that meets the operational definition under the S corporation definitions. And it essentially has to be a U.S. domiciled company. There are a couple other tweaks. So we use about 17 or so filters to pull out the securities that don't qualify in our strategy. But by and large, those are the securities that qualify. They have to be the highest voting rights security. Sorry, I'm confusing that with the sellers. But when you roll over your proceeds into qualified replacement property, you bring to that new portfolio an inherited tax basis from the stock that you sold to your employees, and the holding period gets tacked onto the new replacement property. So if you've owned that stock that you sold to your employees forever, you're holding long-term qualified replacement property from day one, and it inherits the low basis that you probably have in your stock that you sold.
Probably close to zero or something.
Right. Yeah. And that low basis gets allocated pro rata across all the property. So if you buy 100 shares of stock as qualified replacement property, each of those receives its pro rata share of the basis, the tax basis of the stock you sold.
So when people use you guys for this, you help facilitate it, but then you guys have a fund that then they can invest in that fits that criteria to defer that tax.
Yeah, I wouldn't call it a fund. By definition, it cannot be a pooled investment like an LP. So the client has to set up a separately managed account. And in that account, we effectively replicate the S&P 500 through direct ownership of those securities titled in the investor's name.
And then for an advisor working with you, helping on it, they basically open the account at Schwab or whatever their custodian is, and then they use you guys with an SMA, and you guys help manage it.
That's effectively the process. We actually have our plumbing, our trading tech set up through a third-party custodian that we use, Interactive Brokers. And so we're kind of wed to Interactive Brokers, but effectively that's the process, yeah.
Okay, that makes sense. So I think all of that makes sense. I'm sure everybody listening, there's a lot of words in there, which I don't think there's any way around that, right? Because then I say fund and it's like, well, fund, I can't generalize as a fund. It has to be here. So maybe a good way to kind of recap some of this is like, okay, so we talked about the other ways to sell, and some of the advantages of that might be upfront liquidity. This might put you a little behind in upfront liquidity, but that's okay. The advantages here are you get to keep it internal to your company. A lot of times people are saying, I want to sell. I know what happens when private equity comes in. We have some good high-level managers who could kind of step up and take over. So the advantage is you keep it in the family. You keep it with people who you know care and want to make sure it grows well. And obviously you could still find somebody else other than private equity potentially who'd want to do that. But like the benefits seem the tax deferral, right? So you get to keep it with your company. You get this tax deferral as long as you go invest it correctly in those assets that qualify, potentially get a step up in cost basis and never have to pay that tax. Sure, if you have to liquidate some to kind of fund some of your life, but in general, if you get quite a bit of money, that account is going to have dividends and help generate just from that income that you would need. What other benefits am I missing?
Lots of benefits. Like I said, it's essentially a purchase price deduction on the sale, and the business owner then is effectively rolling out to his employees a new way to create wealth. Often what they find in studies is that employees from companies that are employee-owned versus, say, their straight 401k peers are accumulating wealth at 2.5 or 3 times the level of those employees from other non-ESOP companies.
Because they get exposure to a private company that's rapidly growing versus, not that the markets are bad, but you're going to assume less growth in the market than that private company.
I don't know that you're going to grow any less fast than a private company, but it's a terrific benefit to be able to enrich your community and your employees like that, creating a legacy for yourself. And most of the business owners that we work with are kind of paternalistic in that sense. They want to give back and say thanks to their employees, and it's a wonderful way to do so. And of course, companies that are employee owned don't move their manufacturing to Mexico typically. They are usually more productive. They don't default as much. I mean, the statistics are pretty compelling that these are more productive businesses because the employees are imbued with an ownership culture. In other words, they take their work home with them. They think about the business's problems just like an owner does. And we're in the business of creating capitalists here, right? One employee at a time, but it's a marvelous thing. And you've broken down those adversarial relationships between management and labor that we typically see plaguing automotive industry, for example. My goodness. So this is the answer to a lot of problems in this country, and it's based on good old American capitalism at its finest.
So maybe the other side that we need to understand a little bit deeper mechanics wise is for the employee. So I'm an employee. The owner decides they're going to do an ESOP. For me, it's, do I get to choose? How much can I put in? And then mechanically, like, where does the shares that I'm buying, where do those go? How do I ever get out of it? Help us answer those.
Most ESOPs we observe also have 401ks, so that's worth raising. But in an ESOP plan, an employee stock ownership plan, what happens is that the shares get allocated for the economic benefit of the employees on a basis that is equivalent to the payroll breakdown. So, for example, typically the most expensive employee in a company after the owners, maybe the CFO or president, that individual will get his pro rata percentage of the stock that's allocated every time there is an allocation. And as I say, the allocations of stock to the employees in that trust happen as the trust is essentially buying that stock. Again, paid for with the contributions by the company over time. So the employees receive allocations of securities. Those securities, until about the age of 50, effectively compound over time in value. There's a valuation every year. So what you have is essentially a marketplace for the stock of the employees that is valued every year. They have a stock price that they go home with every day, just like a public company in a sense. And those employees have a way to gain liquidity now. At the end of their careers, they can diversify out of the employer stock into a more diversified basket, or they can retain their concentrated holdings in the...
They sell back to that trust.
But they'll sell back to that trust at the time of their retirement, typically over a period of time. Just like a 401k plan, employees vest into the plan. So you don't just show up day one and get your stock. That's a concern of employers. They want to make sure that there's an incentive period there where... So
it's part of comp. It's not, hey, I'm choosing to use a certain percentage of my income to buy.
That's exactly right. So employees pay nothing for it except their sweat equity, because the company is funding this transfer of shares through the cash flows generated by the business as part of its contributions to the plan.
That's really interesting. Okay, yeah, I think most people, when they think of ESOPs, did not assume that this is like a part of your compensation. I think the assumption is this is like a 401k deferral where, hey, I'm choosing to put 0 to 15% of my income in and I have to buy. So really all employees relative to their earnings get a certain percentage. Higher up, higher earnings give you a higher amount. And so as the owner, you might even have, the new owner, you might even have a thing to say, hey, like this is part of your comp here. And this is why potentially your salary is maybe a little bit lower or whatever, is because of the added stock you're getting inclusive of your comp.
I don't know that I would call it that. I would call it a benefit, just like the employer match is a benefit. That's how we typically think of it. But yes, that's exactly right. And every year, as the longer the ESOP plan's been in existence, the employees become more accustomed to thinking, as I say, with that imbued ownership culture. Every year they anxiously wait for that stock price valuation to understand what their plan's worth. It's really a marvelous benefit.
And right, you have that benefit of, you probably as an employee care a lot more about the work you're doing, what's happening with the company, et cetera, because you get to see share price and your net worth change by how well the company is doing.
That's right. I'm fond of a story told by a local ESOP owner, I should say business owner, who sold to an ESOP. He came down onto the factory floor one day and saw one of his employees doing donuts with a forklift. And another employee was standing there looking at him, watching him do it. And this business owner was shocked. And he said, what are you doing spinning donuts in his forklift? And, everyone was like, oh, he thought he was busted for, joyriding on the owner's forklift. And he realized in that moment, oh, no, I'm destroying company property, my property here. So that message takes a while to sink in, but eventually it does, and I think it's a marvelous transmogrification toward capitalism and, again, taking your work home with you.
Yeah. Okay. That makes sense. So maybe last place to wrap up is like, who is this a good fit for and who is this a bad fit for?
I think the best way would be to share maybe some of the breakdowns of our client bases. I can give you a sense out of our, say, 105, 110 investors. So about 20% of those investors come from construction companies, like pure construction. Another 20% are from an industrial products background, painting or other kinds of fabricated products, fabricated steel, for example. There is engineering and architecture that forms maybe 10% of our investor base. Another group might be business services, so data analytics or other kinds of business consulting services. We've got a bunch of clients who do that. Other products, other services kind of round out the rest. It's a pretty diverse group. There are some benefits for government contractors to be employee owned and so forth, but I would say it's a broad group. Companies that grow kind of in the 5 to 15% a year range in terms of their revenue are good candidates. You've got to have some growth. You don't want to be growing too fast, because if it grows too fast, remember, at some point in time, the company's got to buy back the stock of those employees. And so an AI tech company is going to be worth $1 billion soon. It will outstrip the ability of the company to generate the cash required to buy out that employee's stock at retirement time. So you create a liability down the road when you take on employees. You have to be able to fund that when you buy out those employees. And like at a 401k plan, those employees will get their money and pay income taxes on that when they get their disbursements.
Okay, makes sense. Is there any company like, do you typically see you have to have like 10 plus employees, or is there, what's kind of that number?
I think kind of to keep it relatively clean, there are people who tell me you can go lower than this, but I think 15 full-time employees is a reasonable floor for the size of the employee base. They have to be U.S.-based full-time employees. I think you can also do Puerto Rico as well. Anything that essentially has ERISA or some version of ERISA as its overarching regulatory framework, it can be an ESOP. But overseas employees cannot be part of an ESOP plan, and that creates complications for much larger businesses.
Okay, that makes sense. And it's funny you brought up Puerto Rico, because Wes here lives in Puerto Rico, and we were talking before this. This is, living in Puerto Rico, tax benefits, et cetera, is something that people bring up all the time. And it's good for some, bad for some, a lot of like murkiness and how do you do it? How does this work? So we're going to have Wes back on in the fall, and we're going to have him kind of share all of the knowledge on how Puerto Rico works. But I think this has been a really awesome episode. I know for a lot of people listening, this is like very technical, very deep, but there's just certain areas like, there's other things that you guys do as well on with investments that there's just no way to not be technical, because, for a lot of people, if you just say this, hey, here's how an ESOP works, generally they're like, well, here's all the issues that could happen. And so unless you get into the technical area to really explain how it works, why it works, the benefits of it, like there's just no other way around it. So really appreciate you guys coming and sharing the knowledge here today. Before we wrap up, maybe let everybody know best places to follow and engage with you or reach out to you for help on going through something like this.
On our side, on the ESOP side, I would say just Google 1042 QRP Alpha Architect, and we've written a dozen articles, you'll get a whole bunch of information that you can immerse yourself in.
Yeah, just hit up alphaarchitect.com. It's probably the easiest. Or just Google it. Like Doug, we write more about this than anyone out there combined, I think. So if you're looking to learn about it, we'll be your source, I imagine.
And give Wes a follow on Twitter. He's a very good follow, big account as well. I'm sure you've seen him on there. But everybody, we appreciate you listening. Please don't forget to rate and subscribe, and we'll see you back for another episode next week.